Hello and good afternoon. Sorry for a little bit of a delay there. We're just waiting. The number of attendees is moving up as we go along, so I don't want to start too quickly and anyone miss the best bits. But anyway, thank you. There's a good list of attendees there, and we've had a good number of questions that have come through in advance that obviously we're going to go through as we go through the presentation today. If anyone who is on the Zoom link now wanting to send any questions, you are able to click the chat button and send a question through, and it can be done in such a way that no one else sees who's typed what. It'll come through to Sky, who will be pointing at from time to time, sat across here. She's in control of all of the cameras, noise, everything else like that. So if anything goes wrong, it's all Sky's fault, which every good boss should do at the beginning of anything like this. So without further ado, there's another person just joined there. We will get on with the presentation now and go from there. So that's good. We've just cut Mike and Matthew off the behind there. I'm sure they won't mind, but they will chirp up at any point they need to. We've put this presentation on today for the 24th of March. As it is symbolic, it's exactly 1 month since Russia invaded Ukraine, and obviously that caused a lot of concern in world markets, and I'm sure all the people who are watching today have been checking valuations and such like over the last few weeks and were concerned at that time. We do have 1 or 2 people on the list of attendees who are listening now who only started the process with Wealth of Advice and investing money towards the back end of 2021. And for 1 or 2 people in particular, it's been quite worrying in so much that they never ever really saw their fund values go up. I was fortunate to have a one-to-one chat with a particular client a couple of weeks ago, and hopefully him and his wife are both listening now. And thankfully, everything's gone up since I was in your house. I've never been lucky like that before, but funds have certainly crept back up. And Matthew, I know, has been in touch with those people, and hopefully people are feeling a bit more reassured now. For me personally, I certainly feel more reassured in so much as if you'd have asked me on the 24th of February, did I think Russia would invade and it would all be done within a couple of days? Well, we'd always been led to believe that Russia was a mighty military power and that the Ukrainians would have probably fallen within a couple of days, and that hasn't happened. So a month on, we're now wondering kind of what is going to happen next. So the agenda for today is what is the latest excuse me, on the situation in Ukraine. I'm sure, as I say, people watching this, whether live or on the recording that we're going to send out after, will be seeing lots of this in the news on a daily basis, obviously. And it is quite frustrating, really, that if you think about what's been in the world news going back to 2016, so 6 years now, it seems we've just been getting battered with negative stuff all the time. Obviously, all the Brexit stuff. Then we had Trump jump into the White House and cause all sorts of hassle and problems with China, trade wars and such like. And then that starts to calm down a bit. And then COVID comes along. 2 years on from COVID, you were just starting to think, well, everything's hopefully getting in the rear view mirror for COVID. And then this war in the Ukraine happens. So it's been definitely volatile times, more volatility in the last few years than we've seen probably in the previous few years, going back to the financial crash of 2008-9. But here we are with this situation at hand in front of us now, and how we're going to deal with it going forward. So we're going to then look at what market news, what is affecting things. It's not just the war in Ukraine. Obviously, inflation is a huge, huge problem. Rishi Sunak had his spring statement yesterday, which ended up being like a mini budget, which he'd said in the weeks leading up to it that wouldn't be like that, and then it turned out it was. I didn't bother watching it actually live yesterday because everything that was going to happen was released to the press the night before, and such is the way with things now. It seems there's going to be a lot of political to and fro as to what decisions are going to be made, and is that for the benefit of everyone? I don't know. We're then going to move on to how perspective is everything. Obviously, we've had lots of major events around the world over the last 80 years since the end of the Second World War. There has been lots of times when markets have fallen, and we are going to show some graphs as to how things tend to recover. And again, from a reassuring point, from my point of view, doing this job and going out and speaking to people, and Mike and Matthew are the same when they're talking to people, is this the history it doesn't repeat itself, obviously, but past performance is always a good indicator as to what is going to happen and how things respond. And then we'll finish off looking at recent performance of how markets are doing, portfolios are doing in general. And then, as I say, have a Q&A at the end. As I say, there is some of the questions that have come through already that we are going to cut to, because as I said, there's a question there from one of our clients, John Chapman, who sent it across, which is very relevant for a couple of the slides that are in there early on. So feel free to add any questions in as we go through, and stop me if anything doesn't make sense, obviously. So 1 month on, what's happened since? Frustrating for the Russians, I'm sure, is the fact that they haven't made that entire screen go pink or red with complete takeover of the Ukraine. They've been trying to get into Kiev now for almost a month. And as I said, well, almost it is a month, and we've been hearing lots of heroic stories of how the Ukraine army's repelling them. Obviously, they're getting lots of assistance with NATO countries providing weapons and military intelligence and such like. But we're also hearing very, very negative stories about what the Russian soldiers are being told and how they're being prepared for this, which is very little, and it's not a good situation for those people. They've been dragged into something where I think, well, again, what we're being told is they were told it was going to be training exercise, and a lot of them didn't realise where they were going. And also, Mr. Putin apparently has rounded up and arrested a lot of his intelligence community, who had given reports back to him before the war that the Ukrainians will welcome us with open arms, and it'll all be done and dusted within 3 or 4 days. That clearly hasn't happened, so it's becoming very, very frustrating. And what we're now starting to see is Mr. Putin trying to, we are experts are saying, trying to engineer a situation where he's going to somehow save face. We heard last week that he was talking to President Erdogan of Turkey, and when you actually look at the list of demands and such like that he was asking for in order for a peace agreement to be drafted, there weren't really, there wasn't nothing there that that you would think the Ukrainians couldn't deal with if they are going to negotiate, and it wasn't as far out as what you might have expected. Mr. Putin, obviously, no matter what he does, has to sell it as a victory to his people. So there's a man there who, in the weeks leading up to it, we were being told wouldn't sit in the same room as other officials and such like. He's scared of being poisoned and all this sort of stuff. But here he is in the Luzhniki Stadium in Moscow on Friday, where 80,000 people were there waving Russian flags, singing his name. And obviously what he wants to get across to the population of Russia is that he's been successful in what he's doing. There was a Russian historian on BBC News a few weeks ago who highlighted that over the last 300 years, it is not uncommon for the leaders of Russia to invade neighbouring countries and obviously seek greater political power as a result of doing that. One of the things he was quick to point out, though, is that when any Russian leader does such a thing and doesn't succeed, they normally have their heads chopped off literally within 2 years of that failing. And he didn't believe that Mr. Putin would be given another 2 years if this goes awfully wrong. So hence the reason he stood in a stadium telling his country that it's all rosy and everything's good. And as I say, we're reading stories that there's various high-ranking Russian officials being rounded up and put in jail and such like. So you'll never really know the full truth until it's all over. We obviously get told what our news channels and our governments want us to hear on our news channels, and the same things happening in Russia there now. As I say, Mr. Putin had a meeting with President Xi himself back at the beginning of February. Who knows what was said there? President Biden and President Xi of China had a 2-hour call on Friday. And as I say, Xi is obviously saying that he doesn't want this crisis to escalate himself, because it will be negative for China. China wants their economy to grow, and a healthy, happy world is better for China, in so much as obviously we buy so many goods and items from China that they don't want this crisis to escalate. And as I say, economic sanctions will hit hard on Russia, but it will also affect countries in the rest of the world. The third bullet point there about Russian interest payments being made, there was a fear 2 weeks ago that Russian government bonds would default. and Russia has since made £117 million of interest payments. Again, you put the news on in our country on the morning, you're seeing all these horrific things going on in Ukraine, and you're hearing companies are sort of adhering to the sanctions. McDonald's and IKEA and all these big names, Starbucks, are not trading with Russia. Yesterday, there was a lot of pressure put on Renault, the French car manufacturer, to stop making cars in Russia. But let's not beat around the bush. Russia is still raking in a hell of a lot of cash from selling gas to other countries around the world. Europe, Germany has around about 40% of its household gas coming from Russia. So Russia is still generating income. That needs to be resolved. NATO leaders were meeting in Brussels today to discuss the war as it enters its second month. You would have to hope that President Biden will be speaking with Germany especially and say, look, what's going on there? What can we do to resolve this? And as I say, hopefully that starts. I mean, Russia is starting to feel the pressure of the sanctions and everything, and hopefully we start to see some positive news in the coming weeks. When we look at how markets have performed year to date, you can clearly see that volatility has been rife and markets did go all the way down. As I say, I mentioned I was in a client's house a couple of weeks ago. That was March the 10th. You can see that markets have recovered nicely pretty much since that date, and in the 2 weeks since, things have come back up. And March the 10th was probably the worst. March the 8th, 9th was probably the worst day if clients were logging in, looking at valuations and seeing how things were going. And things, as I say, have rose since then, albeit some ups and downs along the way. The bottom two lines there, the S&P 500 and the MSCI World Index, lagged behind the FTSE 100 since January the 1st. And again, why is the FTSE 100 outperforming them? Well, it's simply because it's full of oil companies, mining companies and such like, which are doing well. But the actual percentage bounce back that you've seen on the S&P, for instance, over the last few weeks has been quite good if you're considering that there. So it's not such a bad picture, as I say, in the short term. Obviously, we want things to pick back up in the longer term as well.
Perfect. And one of the questions that we had in from John from Easington before this was, in talking to other retirees, I've heard that some financial advisors have recommended converting assets into cash. I know that wealth advice advises that this is the worst thing to do. So I was wondering if you had any ideas why others might be recommending doing this.
Yeah, definitely. I mean, Sky, can you put that graph back on so it's on the full screen again, just so I can highlight this point now. So if, for example, we rang all of our clients, emailed all of our clients on February the 24th and said, Russia's invaded, we are trying to think about your sort of mental health at this moment in time. We don't want you to worry anymore. The funds have gone down, but we're going to put you into cash on this particular day so you don't fall even further. I'm sure a lot of our clients would have said, thank you for that call. I really appreciate you doing that. However, when you then look at what happened next on these particular graphs, markets didn't continue to fall. Now, I'm not saying I had a crystal ball on the 24th of February. They could have continued to fall. But the point is, and what you can see on those graphs, markets will always reach a point where somebody out there is going to buy in and the markets will recover. So if we'd contacted our clients on the 24th of February and said, Russia's invaded Ukraine, let's put you into cash, that particular transaction would have took 3 days to complete, in so much as if you do a fund sale on a Monday, it tends to complete on a Thursday. So you're out of the market for a couple of days. There's the uncertainty as to what the fixed price is that you'll get for the sale price. Then let's say we rang our clients back up today and said everything a month later appears to be rosier again. And I know it's not, the war's still rumbling on, but just in this example, let's say Russia had announced this morning that it was going to pull its troops out and it was all over. Well, in that situation there, you've missed the bounce back. That's already started to happen. And if today was the day that the Russians announced that it was a ceasefire, for example, and we said, right, we're going to buy the clients back in, again, every fund purchase that happens takes 3-4 days to complete. You would not be buying back into a unit price until Thursday of next week. As I say, given the time and logistics in there, we're not discretionary fund managers. We can't just buy and sell without getting our clients' permission. So some clients might take a day or two to come back and respond. Those people might be a week later, by which time the markets could have bounced back 5%, 6%, who knows? I mean, the day that the COVID vaccine was announced, in November 2021, markets went up 5% that particular day. So going into cash is never the answer. I personally, and as I say, I'd be happy to have the discussion with any other advisors who disagrees with this on it. But my personal view is, if the client's attitude to risk is that they should be in cash, they should be in cash forever and never invested at all. The vast majority of our people are clients are invested for the medium to long term. And the graphs that will come on to show later on in the presentation will explain more clearly as to why being invested for the long term pays, and how missing those bounce back days can cost very high amounts in the future. That said, we shouldn't discount risk and what it does. This is the volatility VIX index, which again we've shown lots of times in the last few years. Again, without laboring too much, you can see how much it went up when COVID happened. But now when we look at the next graph there, this is the volatility index from the end of October, so the last quarter of 2021 all the way through to the end of the first quarter of 2022, and you can clearly see it's been a rocky ride over that period. But even before the Russians made their move, which was end of February there, you can see as we got towards the end of December and there was fears of COVID coming back and causing more lockdowns, the Omicron variant was all over the press. Excuse me, the volatility index spiked again, then came down as we went through into January, and then has gone back up again, and then the fear over global inflation as a result of surging energy costs is in there as well. But thankfully, the letter A at the end there, you can see that it's coming back down to where it was at the end of October. As I say, that could change tomorrow if Russia decides to do something crazy tomorrow and fire some big bombs about, then it can spike back up. But again, bringing back the question about going into cash, at which particular day do you make the decision to go on there? Because you're always looking back with these things, and it will be absolutely impossible to time it to perfection. And as I say, if someone's going to retire and be invested for 25 years, or if someone's going to start a savings plan when they're 40 because they're going to retire in 20 years' time, missing out on those days when markets bounce back up is going to cost. But also trying to predict when the most volatile days are going to come next is almost impossible as well. So the next part of the presentation, we're going to look at general market news, having obviously an update on inflation, which is obviously very worrying for the markets right now. I think it's probably the most worrying thing we have. Obviously, I know we've got the situation in Ukraine, which we're seeing on the news, but right now, that figure there of the CPI hitting 6.2%, so that's annual UK inflation above 6% in February 2022. Those figures are higher than they were for the last however many years, 25, 30 years. One article I was reading yesterday was saying that it's like what it was in the 1970s. You will forgive me, I wasn't born until 1979, so I can't remember that. But I'm sure some clients watching this might do. We don't want inflation to be that high forever, because it will just wreak lots of problems and cause markets not to perform well in the long run. Government bonds, corporate bonds don't like inflation. Inflation gives them an allergic reaction in so much as they don't perform well at all. Stock markets will perform negatively and be volatile in the short term, but stock markets will have the chance to recover once higher inflation fades through to higher profits for the companies out there. Because that's the other thing with everything that's going on right now. Companies who are able to charge high for their product will take an opportunity to charge high for their product. So in times of high inflation, it is an easy time for a manufacturer of anything just to come back and say, oh, well, because of inflation, we're increasing our prices. So that's kind of going on. So when you look down the list of the list of products on there, every single area you can see is going up in value, and it's not just the oil price. Food, clothing, furniture, everything seems to be going up. No matter where you go, who you talk to, things are costing more. And you've got to remember, over the last 25 years, although the cost of oil and energy and food might have been going up, it was always countered with the fact that other items were going down. Furniture, household goods, gone down. White goods items. I was recounting this story yesterday to a client. Obviously, I went to university in 1997, and I packed up the car to head off to Manchester with a bright, nice, shiny, brand new computer that I bought from PC World that I believe cost me around about £1,800. Right now, if you went to spend £1,800 on a computer, you would be getting, and that was a crap thing really at the time. If you went out now and bought an £1,800 computer, you're getting the best Apple Mac, or you're getting the best Microsoft Surface Pro. You can get a very, very good computer. The laptop in front of us now, that HP one there, is one of the best ones you need. That was 600 quid. So that's just the example over 25 years how electronic items went down in price. Big TVs, everyone's got a 60-inch TV hanging off the wall these days. Price of all that went down. Lots of things was deflationary over that period. But right now, it doesn't matter what you're looking at, prices are going up and it's not good. Mike and Matthew were at the pension investment seminar down in London in January, and a lot of the fund managers down there were saying that inflation was going to be a problem in the first half of this year, and then it was going to dissipate in the second half of this year. And at that particular conference, I don't believe there was too much concern about what inflation was going to look like in the second half of this year. However, now all bets are off, so to speak, because we don't know what's going to happen with Russia and what's going to happen with the supply of energy to the rest of Europe and the rest of the world. And obviously that's prompted Rishi Sunak to do certain things. Obviously, I know he had his spring statement yesterday, but just before we get to that, you will have noticed last week that interest rates went up to 0.75% in this country. US has raised theirs to 0.5%. Interest rates are increased by central banks to try and counter the effect of inflation. The hope of increase in interest rates is that spending will reduce, and if spending reduces, inflation goes back down. I think the problem they've got right now is the fact that inflation is mainly linked to the higher energy costs, and I cannot see what the UK government increasing its rates to 0.75 is going to do to counter that. The UK would love its interest rates to be back to somewhere closer to 2.5%, because if you get them back there, then you've got a tool or a lever that you can use in the future if we ever went into recession again. You reduce interest rates and people spend more, so they obviously want them back up.
We did have a question come through, which was, where do we expect interest rates to be by the end of the year, or where could they be?
Yeah, well, as you know, when we're down in London, a lot of the experts were forecasting interest rates, both in the US and the UK, we're in the air around about 2%. Both the central banks are anticipating to make 5 or 6 rate increases this year. However, it's going to be gradual rather than big lumps, just to avoid the shock. Very much like Chris was saying, they don't want to get up to 5, 6, 7%, and they feel that a smaller increase will actually control inflation. Because if they do any quicker, it'll stunt growth, which is obviously the last thing both governments want to do at the minute, as they've obviously got the burden of higher debt. So yeah, hopefully around about 2% by the end of the year.
Good. I mean, as I say, a lot of the clients who will be watching this now probably don't have mortgages anymore. Obviously, younger people, I think this is obviously how a lot of stuff that's going on in the world right now is affecting younger people more. High inflation. Obviously, people putting petrol in the cars being absolutely decimated in the last few weeks, their outgoings. I filled my car up on Saturday for the first time probably since the end of January, and it was 95 quid the last time I filled it, and it was 127 on Saturday. And even when I was pressing in, I was looking at when's this going to end. So anyone who's relying on the car every day of the week is going to be sort of massively out of pocket. Obviously, food prices have gone up, other things, but now, as I say, rising interest rates. So anyone on a tracker rate mortgage will be seeing their mortgage costs going up, and then you couple that with rising energy costs, which is expected to go up massively in the month of April. People's house gas and electric bills are expected to go up. So it does appear to be lots of bad news for certain people, certain parts of society. But then the statement at the top there, as you can see, it's not all be negative. Last week, the S&P 500 in America rose by 6.1%. It was its best week since November 2020. And as I say, I was having client review meetings last week where we were showing one particular US fund that we invest clients into, which was negative over 12 months. I then sat in a client meeting yesterday, and I'm looking at the same fund, and over 12 months, it's up 4.5% over the 12 months. You think, well, that's how quick things are changing. US markets went down massively in the month of January. A lot of the big, huge technology companies saw share prices falling. Facebook, which is now called Meta Technologies, had a very negative time because the European Union and also Google was kicking them where it hurts by not giving them the data that they want back out. If they can extract data from their clients for the people who use Facebook, then they can sell it for marketing companies. And just as an example on that, we have opened our office in Charles Sales a few weeks ago, and I was able to go on our Facebook page, post an advert where Facebook was able to target anyone over the age of 50, under the age of 63. I could exclude Newcastle or Sunderland fans if I wanted to. I could pick BMW drivers and not Audi drivers. The amount of things that people post on these things, which tell you who you are and what you're interested in, is quite frightening. And Facebook harvests this data, and then they can sell it on to advertisers. I restricted our budget to something like 20 quid a day, which knocked out a lot of these different features. But it worked. It was good. As I say, it generates new inquiries, and that's what Facebook's all about. It's advertising revenue. Do you think that company's going to go bust? No. Well, a lot of fund managers would have therefore been piling in at that share price being down by 30% as it was during that month. Other US companies, Netflix, Amazon, even Amazon share price went down. So, and as I say, they're bouncing back nicely, which is why you saw the S&P go up by 6% last week. Next, just looking at Rishi Sunak's spring statement. As I say, I mentioned going to put some diesel in my car on Saturday. Should have waited until after Tuesday. It's down by 5 pence a litre. It took 66 litres to fill my tank on Saturday, so that would have only saved me a couple of quid. So I don't really see how it's going to make that much difference. He said it's going to cost the economy £6 billion, but they are generating lots of tax. The national insurance increase is going to stand, albeit that they are bringing the national insurance threshold up to the same level as the personal allowance. I have never understood why there was a difference between the two. I think this should have been done a long time ago. The national insurance threshold was previously, if you earned above, I think it was about £9,000 a year, you started paying national insurance. Now it's being brought in line to £12,570. That will knock out a lot of lower income people who will pay less national insurance. And I think someone was telling me this morning, is it 39,000?
39,000.
39,000 is the figure where if you earn above that figure, you will be worse off, which is good. Because as I say, you're looking at, I mean, even staff who work for us, the 25, 26-year-olds who've got student loans, which are now being charged on a lower level of salary, national insurance increases. I mean, we've got Sky sat up to do past a driving test a few weeks ago, went and bought a car straight away, and within days of passing your test, the cost of fuel and the things going up and up and up. So it's not good, as I say, for the younger people. And Rishi Sunak, he's getting pressure from all angles as to he needs to do something to sort this, or we could see a real massive negative in our economy. The Office for Budget Responsibility has forecast that UK GDP is only going to grow by smaller amounts than what it was previously anticipated. I think it was going to be 6% in 2022, and they've now cut that back to 3.8%, back down to 1.8% next year. What I would say about those figures, I wouldn't sort of look at them too much because they're changing all the time. And with everything that's been going on in the world, it is so unpredictable. But they do hope that inflation to be under control and not be a problem, and as I say, debt to be reduced and the economy growing by 2024. And then, as I say, on the back of that, Rishi decided to announce that he was going to cut income tax from 19 down to 19% from 20% in 2024. I'm quite cynical. I looked at that and I thought, why on earth is he announcing that? I don't believe he'll still be Chancellor in 2024. He's obviously got aspirations on having the top job. Maybe Boris, who is a bit like Teflon, so he might be around forever, but Boris may be gone as Prime Minister by then, and Rishi steps into his shoes. So Rishi today or yesterday is just a nice little hand grenade straight into 2024 for his successor to deal with a 1% cut in income tax. It will be the next election year, so I don't think they're going to change it now because it'll be a massive vote loser. But it is certainly something to say, well, let's look forward to 2024. If we can get things under control, we'll reduce taxes slightly then. Next part of the presentation, as I say, we said perspective is everything. Why it's better to take a long-term view with all of this. As I say, when we're having these discussions with clients, lots of events have happened over the last however many years, and as you can see from those lines filling that graph there, various events have happened which has caused markets to fall. Markets typically recover, and as you can see there, it's normally within 3 months. It's very rare, as you can see there, in 6 months, if ever, that you are still going to be in a loss position from when these major conflicts. And as I say, doomsday predictions will never be good for an investment strategy, but markets will recover. The outlook for what we have in the future will obviously, as Rishi Sunak showed there, will be more negative when you have these things going on. But again, if you look at some of those lines in the top, I mean, the one that I always highlight, I remembered from being the first year that I was giving advice, Iraq war, it was called the Baghdad bounce. We invaded Iraq, and within days and weeks, the markets were flying up. And as you can see there, that's the sky blue line at the top. If you'd been invested 6 months after we invaded Iraq, you were over 20% up from where you were the day it happened. So war isn't always bad for markets. As I say, there's always that shock at the beginning, as you can see on the left-hand side, but things will typically pick back up. Again, go back to that Mona Hammer, the question John sent in term which, but why on earth would you go into cash when there will always be a turning point? And as I say, I don't want to scare people. People have then asked, well, what happens if the nuclear bombs do start getting sent out? Well, all bets are off at that point because we're all probably dead. But as I say, from what's happened so far in the last 100 years of how, as I say, conflicts have developed, markets tend to recover, and it won't take too long to recover. Time in the market is impossible, and this just again reiterates the point. If you are fully invested and don't come out of the market, and you had done this for the last 20 years, going back to 2001, this is annualized returns. If you've been fully invested in the UK equity index, and you never come out, you're 5.6% year on average returns. If you miss the best 20 days, you've made a loss over that period. It's a massive difference. If you miss the best 30 days, it's negative 2.3%. But the difference in growth from being fully invested and even just missing the best 5 days over that 20-year period is massive. That's 3.4% a year annualized as opposed to 5.6% annualized. If you're going to be invested in a drawdown strategy, a long-term growth strategy, whatever it may be, you've got to be invested for the long haul and not come out. The next graphic again just illustrates that 21 of the best days in the last 20 years were within 2 weeks of the previous of the worst 30 days. Sorry, it's a bit of a mouthful to me to get out. Obviously, it's better to be in the black than in the red, and that is what we want to achieve from our clients. Remain invested, take the long-term view, and things will recover. Another very pertinent point now, clients who are logging in, checking their valuations on a daily basis. This is another graph that we've printed from 7 Investment Management. Not an investment company we use, but the source is actually Bloomberg Finance. And as you can see there, if you were looking at your valuations on a daily basis, going back to 1990, you would have been looking at negative periods 46% of the time and positive periods only 54% of the time. And as each delay kind of gets a little bit longer, whether it's weekly, monthly, quarterly, or yearly, the less often you look, the less time you're going to be sort of looking at negative things. Me personally, I would always recommend looking monthly or quarterly. Daily, weekly is not going to, as I say, help your mental well-being if there's negative things going on. But some people during these times of crisis will look, and it's inevitable that you're going to look. And the next slide kind of just illustrates the point of how many different events go on all over the world. And this is only since 2008. We've been told for many, many years now we live in a more globalized world where what might happen in North Korea is going to affect what happens in America. It might have effect in the UK. The Brexit votes on there, Ebola, remember that one that broke out in West Africa, and how that was affecting world markets at the time. Even terrorist events, you've got the Boston Marathon bombings on there that affected markets negatively. It's just non-stop that these world news stories will come out, and markets will go down as a result. But as you can see from the green line heading up in that direction, things will recover. A bear market is when markets go down. A bull market is when markets go up. So obviously we would always want to be in a bull market. However, like anything in life, there's often the expression, what goes up must go down. But the average bear market, you will be pleased to know, this goes back to I can't see the number at the bottom there, 1942. So that's during the Second World War. As I say, you can see from that there that the average bear market when markets go down lasts no longer than 11 months. And the biggest drop you'll see on average is 33%. However, a bull market when markets are rising will last on average 4.8 years. And will go up 164% over that period of time. So again, why would you remain invested? Because you're going to miss the growth over the longer run. Anyone who's coming out of those investments when markets are at their worst are going to miss those bounce backs. We've overlaid there on the right-hand side, is it to say how the S&P, the MSCI World Index and the FTSE 100 have performed over those periods of time. And as you can see, it does correlate with it. Remain invested and you will get good returns. We did show this graph, I think, one of the updates a few weeks ago. This is the S&P, the MSCI the World Index and the FTSE 100 going back to 1988. That's 34 years. The average client who comes to see us who's age 55 will have a life expectancy to age 86, they might be pleased to hear, which is 31 years in that example. But as you can see on that graph there, you invested all the way through, you will be rewarded.
Just go back a slide there, Chris, just answering a question. So there's a question from Kenneth from Wynyard. He's saying, without checking your app, is it wrong of me to use the FTSE index as an indicator of how my investments are performing?
That's a good question.
Do you want to pick it up?
Yeah, no problem. I think the quick answer almost is that our portfolios are multi-asset portfolios that are invested in lots of different asset classes. So there isn't one answer in the sense of, if you look at the FTSE 100, that will give you some of an answer, but not the full picture. What we tend to say is looking at the FTSE 100, looking at the S&P 500, that's a good start. The BBC Business page is really good. Their website has a market data tab, and if you click on that, if it's all green, it's a good day. If there's some red showing there, there'll be some negativity, but probably in line with what Chris is saying, checking the investments on a monthly basis, or even using this sort of market update as your time to sort of see how things are doing might be better than sort of refreshing Bloomberg or sitting there in front of the telly, sort of watching those news stories coming through.
Yeah, well, Bloomberg at 8 o'clock on a morning will tell you what the markets are opening up at. Markets close normally 4:30. It's channel 502 on Sky. I don't have Virgin Media, so I don't know what the channel is on there. But typically when I'm getting ready on a morning, I'll click Bloomberg on. And as I say, as long as the trackers along the bottom are looking green, that's going to be positive. But as Matthew said there, because our portfolios, whether, as I say, it's the relative advice model portfolios, the stuff we do with Royal London, no matter who we use, they're all multi-asset approaches. So one size kind of doesn't fit all of just picking one index. But certainly at the moment, the FTSE 100 is outperforming most other indexes. And that's because it's stocked full of oil mining companies. So that is probably doing better than the rest at the moment. But definitely look at Bloomberg and things like that. BBC is a good website. It's easy to get on. Again, just as a final thing on the point of different geopolitical events and how they've affected markets over the last however many years. As you can see, all of these events here have caused markets to fall off a cliff sometimes. Pearl Harbor, Iraq invading Kuwait, North Korea invading South Korea, 9/11 are the worst four. I don't believe what's happened in the last few weeks with Russia and Ukraine has had the same kind of impact of that. And if you think, as I say, Iraq invading Kuwait, I mean, I can remember that as a child when that happened. I mean, Kuwait was quite a small, is quite a small country in comparison, and that caused the markets to fall by 20% at that particular time. What's happened recently hasn't been as severe, and as I say, that is quite surprising. As I say, it is pleasing that markets appear to be bouncing back now. And as I say, on that point of markets bouncing back, we'll now look at, as I say, a few other market indices and see how they're performing. We've got the FTSE 100 there, as I say, since 31st of December 2021 up to yesterday, I think that is 22nd of March. Yeah, so you can say that if you had just been invested in the FTSE 100 and nothing else over that almost 3-month period, you'd have made 2.2%. S&P 500 is still down by 3%, and the MSCI World Index, which encapsulates everything all over the planet, that's also down. Again, we're highlighting the point there at the end of February when everything sort of nosedived, but markets have recovered nicely since then. Just looking down the list of questions that we've got there, is there any other questions which...
I think there was one interesting one in terms of, is now almost a good time to invest? I think someone recently inherited some money. And it was a case of, should they hold off and keep it in cash for a bit, or is now the time to get it invested?
I mean, again, we've got 3 different advisors sat here right now. If we were sat in front of a client, you would hope we would kind of give consistent responses to that. Me personally, I think if we were sat here on February the 24th and someone had a check book ready to write a check out to set up some investments, I might have said, well, hang fire a little bit, let's just see how the next few days unfold. Because as I say, you might be then going to take opportunity, your market's fallen, and invest in a lower point. I remember COVID, there was a client who got his money invested the last week of March, and as I say, that was the best week to be invested, and that was a pure fluke in so much as how you picked not picked, but look back, you got the better days. But right now, do I think now is a buying opportunity? I think yes. As I say, look at what happened just as if you look at the graph during January there, if you get back, sorry, Sky pointing at the laptop, not the TV, what you was going to say. This is a problem doing things live. If you look at the graph during January, the US market MSCI index were falling, and those are some very massive stocks that were falling in value. So I think that was definitely a buying opportunity. And as I say, have we come out with the worst of the Russia crisis? I don't know. This might just be a temporary V going back for something to happen. But as I say, I think now would be a good time to invest.
I think the conversation I'd had with the client as well was, if the time horizon was that 15, 20 years, then it's got to be the right time. If it was anything shorter, you might be saying, well, actually, you'd be staying in cash anyway if it was going to be less than 5 years potentially.
Yeah, but I mean, that's the thing. But just explain, when we talk about investments, the long term is 3 years plus, 3 to 5 years plus. I mean, if we had somebody who was investing now for 12, 18 months or less than 3 years, maybe to, I don't know, secure a house purchase or something like that, and you needed a fixed amount out to pay for something, then yes, you might not be investing when times are volatile. But if you're investing in a retirement plan, the retirement plan for the future of taking money out on a monthly basis is always, well, it's for the rest of your life, and 15 years might be quoted, 30 years might be quoted, but typically I would say probably 90% of our clients, if not more, are invested for what we would perceive to be longer than 3-5 years plus. So as I say, I think it is a good time to invest, and a lot of our clients agree. I know the admin department had been dealing with a lot of new checks coming in for people to secure ISA subscriptions and pay one-off pension contributions before the end of the tax year. As I say, I'm self-employed, and I will certainly be paying another pension contribution in. Obviously, when I pay my contributions in, I've got to decide which particular fund I'm going to put money into. Mine is 100% in the stock market. I'm all in risk, but then I'm not going to be cashing my pension in until I'm 55. If any clients can guess how many years away that is, you'll win a blank checkbook and pen, because it's now only 12 years away, which is quite depressing. I was 43 a few weeks ago, so I can't touch my money for 12 years. So I'm prepared to take that extra risk. Whereas our clients who are invested in these portfolios, wherever it may be, don't want too much risk. So we're certainly not going to put too much risk your way. When we look at stock market performance now over 1 year, as I say, it is pleasing to see that, as I say, all of the major indexes are up when you go back to those particular periods. But as I say, for a lot of clients who are invested in model portfolios, Royal London government portfolio range, whether it's Prudential, you're not just invested in stock markets, you do have government bonds, corporate bonds. So although we're presenting market indexes is actually looking okay over that period of time, when you actually put it together into a model portfolio, which we can see here, risk score 2, for instance, as many clients will be aware, has 60% in government bonds, corporate bonds. Since January the 1st, if you had £100,000 invested since the 1st of January, that's currently worth around about 94,000. Risk score 3, a little bit lower, again, because that's the highest stocks and shares content, and that's gone down more since the turn of the year. That's 93,500. Again, repeat, invest for the long term, and you're going to be rewarded. Risk score 3 over 5 years is still up over 30%. And then when we look at the Royal London portfolios, government portfolio 5, which is the one that has around 60% in equities, that's just shy of 30%. And some of the retirement income portfolios, the risk score, government retirement income portfolio 3 there, up 22% over 5 years, is still positive. Again, we're not even talking about that COVID drop in the middle.
But just chipping in from what some of the fund managers were saying when we're in London, it feels like there's a magnifying glass on the market at the minute, and we're just really looking in at that. You've got to extrapolate it out and pull it back. So the last graph we had on there is much more relevant. We can all talk about a bump in the road. We don't know how long it's going to be, but history's always told us it's curved in the right direction. And with all the media that we have at the minute, the negativity, it's all about how much the market and the indexes are going down. What they don't cover is when it bounces back the next day. So again, the perspective is the longer term view, because it is very, very spotlighted at the minute. So it is worth just putting it into perspective.
Good. Well, that was the end of the presentation and all the slides I had there. We're now just going to look at a few questions that have come in. I know we've gone through a couple of them there, but Matthew can be the question master. Have you got any more questions,
yeah,
Matthew?
I've got a couple. So a client who was on the phone earlier this week was sort of saying if he could afford to reduce his regular income, did it make sense to do that now in relation to his pension, his regular income?
Well, I'll jump into that. I believe a good drawdown strategy, if someone is taking money out on a monthly basis, is that you should only ever be taking out what you need to spend anyway. I mean, obviously, if interest rates were back to 5%, it might be a different argument. But if you're taking money out, you don't need it, and the residue sitting in a bank account and no interest, well, what's the point of that? It's generating nothing. Leave it in the pension. When you say if I can afford to reduce income, again, we're not going to suggest to clients that you should be stopping shopping at one particular supermarket to go to a cheaper one. You shouldn't be taking the car. You should be walking everywhere. You shouldn't be tightening your belts too much. I mean, some people might. I mentioned to some clients when they come in and see me, my wonderful father who's 75 and he still works delivering the prescriptions for the local pharmacy. He does not put his heating on the house. He'll sit in the house with his hat on and his body warmer on a night rather than put the heating on for more than 1 hour on an evening, and he's just tight as a drum. There's nothing you can do about that. And we certainly wouldn't be wanting our clients to live in a similar fashion. I don't believe we have many clients, maybe 2 or 3 tops, who are in a drawdown strategy where there is a fear that they're going to run out of money because they're spending too much. I think the vast majority of our clients are in a good situation where they have a sensible amount of taking a sensible withdrawal from whatever funds they have.
And if that question was about is now the right time to upgrade the car, is that where it's a slightly different answer?
Yeah, definitely, because again, think back to the COVID situation, and we had a lot of clients who were thinking about doing stuff that summer when the markets fell, put those plans on hold, and in that situation just left it a few months. Markets came back and did it then. But certainly right now, if you're going to be taking, I don't know, 10 grand out of a fund that's down 4 or 5% from the beginning of the year, well, you're having to cash in more units from what you would have done if you cashed it in on January the 1st. I mean, you can't wait for everything in life, and you certainly shouldn't be sort of putting off doing things that will improve your life and improve your situation. I mean, if you're driving around in a clapped out old banger that's going to drop down at any point, then don't do it. But certainly don't be
a new car anyway at the minute.
Well, there's a particular client who he's not listening to this, and I don't think he listens to updates. Who every time he comes and visits us, he visits the BMW garage on his way home, and we're now saying, "We'll come and visit you at your home address, so you're not going to go in there and buy another new car." Certainly, don't be doing that. There we are, back in the room. So that is definitely the issue of going doing things live and me talking too much. The battery in the camera, which has just been changed, must last 50 minutes before it dies.
I thought that was the best answer.
So all we were saying there is to close off on that final question that we had there is, don't be scrimping and saving if you don't need to. If you're in a good position, you've got good level of funds, spend what you need to spend. Certainly don't be just running out and buying the new BMW or Mercedes because it looks nice in the showroom, but because now you will be cashing in more units to get out the money that you need. Hopefully, as I say, markets pick back up in the next few weeks, next few months, and we're back in that position where that doesn't really apply. There was one question which I know we haven't answered, the one from Ron, which was about doing monthly drawdowns and how does charges affect things within the wrap portfolios. So whether it's AJ Bell, Standard Life, Fidelity Funds Network, Quilter, I think is another one who we use. They will always keep a portion of money separate to cover ongoing charges. So that's not cashing in units on a monthly basis. So I think the crux of that question is, are you being penalized when markets are going down? The answer should be no, because you should be moving roughly 1.5% into charges on a 6 monthly basis. The more traditional contracts, the standard personal pensions that you'll see with Royal London, Prudential, those sorts of people, they just deduct charges automatically out of their unit price. And there's nothing we can do about that. We believe that we have everything set up and structured with the wrap accounts and the fund platforms in such a way that clients are never going to be negatively impacted with any of that. So thank you for listening, everyone. I can say the number of attendees only dropped by 1 when the battery went off on the camera there. So thanks for persevering with us. Obviously that won't go on the one that we record and send out. So I'll now do a second ending. Someone was asking, do we have a bloopers and outtakes once from things we've done? I do apologize. On the last one I recorded last week, I was unable to say the word oligarch properly. I was saying ugly arc. The amount of funny jokes and things I got sent was about me being an ugly arc afterwards was great. But I haven't said that once today. Until now. So just to sort of finish off, thank you for sort of listening. I hope you found it useful and informative. Again, anyone has any questions or issues that they want to raise with us directly, please get in touch. From the list of names I can see down there of who's on there now, there's a lot of people I've seen in the last few weeks. Anyone else who is due a review, you'll be getting contacted in the near future. But if anyone wanted to see us anytime sooner, then as I say, please just get in touch and we'll hope to help then. So thanks again, and we will see you all later. Bye now.